Good morning all. Welcome to this briefing on EQT Holdings Limited. This is Mick O'Brien. I'm the Managing Director of EQT Holdings Limited, and I'm here with Philip Gentry, our Chief Financial Officer and Chief Operating Officer. So this morning we're going to give you a review of the FY17 results. Philip's going to take you through the financials, and then I'm going to talk to you about our plans and our strategy, and then we'll take questions at the end of the session. So let me look at the FY17 year. It was a great year for the business. We're really happy with the performance, significantly increased profit through the course of the year, reduced costs, which came with major effort throughout the course of the business, and our underlying growth in funds management and funds under supervision was really strong. Has been a successful year in terms of transitioning the business. We've restructured the company in a couple of ways by putting firstly the Top Hat company in place and reorganising the corporate structure, a reorganisation of the leadership team earlier in the year, and an operating model review that was designed to improve customer service and productivity, as well as improving our cost base. We completed the acquisition of the Sandhurst business, which was a nice acquisition, fully aligned with our business, and we've strengthened the board with two excellent additions through the course of the year. Forging ahead, our agenda is a growth agenda. We're underpinned by very attractive fundamentals, both the demographic side of the Australian population and also the growth in superannuation assets. And we're a specialist trustee company, and we're looking to leverage our strengths and our capabilities in that area. And we see opportunities, organic opportunities, partnerships and acquisitions across the board in the business. So the results through the course of the year, the performance in our corporate trustee services area has been excellent. I'll show you some of that. We're seeing improving momentum in trustee and wealth services. I talked about the operating costs, but also the one-off costs were down significantly, less than half from what they were last year, and that's contributed to the result. We had a really significant improvement in two key drivers of the business. Firstly, our staff engagement and our client satisfaction, which are really key drivers, and I'll come back to those through the course of the presentation. We granted more than $67 million in philanthropic grants through the course of the year, and that really is the heart of our business, and we're increasingly trying to capitalise on the branding of the business around our philanthropic activities. Our funds under management, administration, advice and supervision were up 6.4%, so it's a really solid result, up to $69.7 billion. Our net profit after tax up 16.2%, which was really a significant improvement. Basic earnings per share up 15% to 77 cents. And I'm pleased to say the total dividend for the year is 71 cents, so it's up from 68 cents, so a 3 cent increase or 4.4%. Well, we've done a lot of hard yards through the course of the year, and I feel we've really repositioned the business, and it is really set for us to focus on each of the lines of the business to grow. We did a major upgrade of our risk assurance function. It was a big investment, but it is starting to pay off by positioning us as a specialist trustee with a very competitive offer in each of the lines of business. We repositioned our superannuation offer, and that was to reprice the product and also to outsource the administration. And again, that's really positioned that offer now as very competitive, which now enables us to confidently go out to partners and other players to provide that service. In the corporate trustee services part of the business, we exited out of third-party funds distribution, which has allowed us really to focus on the core, which is the fiduciary service to funds managers. The operating model review has produced improved productivity for the business, $2.7 million of annualised savings. We had set ourselves 18 months to achieve that. We actually got it achieved in the first 6 months, and those savings were accruing from February of this year. I mentioned the Sandhurst acquisition, which is absolutely in line with our strategy. Philip's going to talk to you about the balance sheet and the strength of that and the low gearing. And we've had a really stable leadership team through the course of the year, and really comfortable with the experienced leaders we've got leading each part of the business. We strengthened the board with the appointment of Glenn Sedgwick, who brings to us great expertise in strategy, in management organisation, in technology and Asian experience, and Jim Minto, who has great experience in trusteeship, superannuation, investments, and as a real industry leader has added value to shareholders. We also announced a couple of weeks ago that the Honourable Geoffrey Kennett AC will succeed Tony Killen OAM as the chairman of the company, subject to his re-election at the AGM in October. And I'm delighted that Jeff is going to take on that role. He's very passionate about the business. Everything he's turned his hands to has been a success, and we're really looking forward to his leadership of the business in years to come. Let me just talk about the highlights for Corporate Trustee Services. It really is a fantastic page. You can see through the course of the year, the number of new managers that we brought on as clients was 15% up on the previous year. The number of new funds that were established through the course of the year was 25% up on the prior year. And then the last block there, from the new funds that were established for both our new clients and existing clients, the funds under supervision was up 42% on last year. So $7.5 billion of new funds under supervision from new funds that were established through the course of the year. So it really is a really solid result for that leading business. I'll just give you a flavour of some of the names. And I think the important thing about this slide is there's a good mix of Australian-based funds managers and globally based funds managers. Also a good mix between those that are new clients to the firm and those that are establishing new funds. And the other point I would make is that we're seeing a trend to more of the top-line Australian equity managers entering into the retail market and therefore requiring registered funds and RE services. And we've been very pleased that we've been able to provide services to those types of funds managers. If I look at Trustee Wealth Services and the highlights here, you can see that we've had good growth in all the lines of business. On the left-hand side, in our core trustee services, estates administered is up 79%. Had 87 new testamentary trusts established through the course of the year. That's a 9% increase, and 14 new perpetual charitable trusts established. Then on the right-hand side of the business, I'll note that the legend is a different size. These are emerging markets for us. So Community Trust, which is primarily our Indigenous trusts, we're seeing some early growth. The living donor part of the business, which is going to be a big focus going forward, also had good growth. And we had really good growth in the compensatory trust side of the business, where we feel we're winning a very significant share of new trusts that have been established in that area. Sandhurst Estates and Trust business was acquired through the course of the year. It was a $5 million acquisition. The integration and transition of the business under our ownership has all gone according to plan, and we completed that on time. I'm pleased to say the 5-year mutual referral agreement between ourselves and the Bendigo and Adelaide Bank has been working very well. We've been able to talk to all their financial planners, and we're starting to see leads come from that. We're really happy to launch the business in Bendigo a couple of months ago and been very much welcomed by that community and by the bank. Remind people, we said that this would be EPS accretive in FY18 of about the order of revenue of $2 million per annum and increased EBITDA of $1 million per annum, and we fully expect that to be the result. We set ourselves 6 key drivers of the business. I'm just going to touch on how we've gone through the course of the year on each of these. The first is client satisfaction, and this is the first time that we've measured our clients' satisfaction. I'm pleased to say we got a net promoter score of +12, which is a very positive result, and in many cases the client satisfaction with our services is around about the 80% level, in some places over 90% in parts of our advice business and the like. So a really good first start on client satisfaction. The next key driver for us is employee engagement. And our employee engagement increased by 18%, all, I admit, off a low base of 49%, but I'm really pleased with the trend of that, so it indicates that people are clear about our strategy. Funds under management, advice and supervision increased by 6%. I've got there normalised plus 26% because we'll talk about one client loss that had been very well flagged to the market. There was a $10 billion client in our corporate trust area. So taking that out means that we had underlying growth of 26% in funds. Growing the sales value. So this is about the increased sales capacity and capability of the business, and particularly focused on valuable sales. And that's going to be a big focus for us in FY18 as we seek to measure that more carefully and focus our business development efforts. The operating margin stayed at 32%. And deepening our community impact, as I said, we granted $67 million of grants throughout the year. It was 4% down at a headline level on last year, but last year's result had an abnormal grant of about $8 million, so 6% grant and on an underlying, 6% growth on an underlying basis. That's all led to EPS growth, which is over 15%, and a return on equity that's approaching 7%. Obviously, we'd like that to be higher, but it's trending in the right direction. So that's all I'm going to cover right now, and I'll hand it over to Philip to take you through the financials.
Thank you, Mick. Let me now just take everyone through the financials in a bit more detail. Firstly, looking at the profit and loss, you'll see at the top of the chart here, the operating revenues circa 4.5% down year on year, and that largely reflects the superannuation restructure, which composed two key elements. Firstly, outsourcing the superannuation administration to KPMG, and then secondly, repricing the product to make it more competitive. And the other element of the operating revenue reduction was the exit of funds distribution some time ago now. Coming down the P&L, you can see the operating expenses were well down, and in particular, non-operating expenses substantially down, and I'll talk more about those shortly. The net profit after tax up significantly, up 16.2%, and a very solid increase in dividend from 68 cents in the FY16 year to 71 cents in the FY17 year. Now let me take you through the one-offs in a bit more detail. On this slide, you can see the half-on-half tracking of the one-off performance over the last four halves. And firstly, at the top of the slide, you can see the first four line items there: the business assurance project, the operating model review, the corporate restructure, and the superannuation restructure, all complete on time and on budget, and a modest amount of M&A associated with Sandhurst trustees in the second half of FY17. And right down the bottom of this chart, you can see the steady but consistent reduction half on half over the last four halves. You see total non-operating items around 0.9 million for the second half of FY17. I'd expect there'll always be some, but they should continue to be on or around that sort of level rather than the high levels we've seen previously. Now let's look at the revenue side of our business. In this chart, you see what we portray here as the underlying revenue growth, which is around 8%. We've stripped out the exit of CTS funds distribution, the superannuation restructure, and the impact of one large client that Mick referred to earlier to get us to an adjusted revenue for FY16 and a circa 8% underlying revenue growth, which is pretty healthy. The main driver of this revenue growth has been growth in funds under management, administration and supervision. And let me show you a little bit more about this in the next slide. Here you can see components of funds under management, administration and supervision for each of TWS, CTS and for the total EQT group. Now it's very strong on all counts. Clearly the growth in TWS is in a significant part accounted for by the acquisition of ANZ 2 or 3 years ago now. But in CTS, it's entirely organic and very strong, and obviously still very strong for the group as a whole. And now looking at each of TWS and CTS in a bit more detail. Firstly, with TWS, their revenue growth underlying has been more modest. And you can see when we strip out the superannuation restructure impact, the revenue growth is relatively flat. Let me just explain that in a little bit more detail. In fact, there's been underlying quite strong growth in philanthropy and reasonably good growth in funds under management, administration and supervision, as you can see on the right-hand side of the chart. This has been masked somewhat by some positive one-offs that came through in FY16 and which have essentially somewhat inflated the FY16 result. Also, the advice revenue is somewhat down on FY17, and that's a function of principally some clients passing away And while that obviously reduces advice revenue, we will see that revenue pick up and come back through the business, through the estate management and estate planning area and trusts over the course of the next 12 months. So it won't be lost to the group entirely. Now having a look at CTS. Here you can see the underlying revenue growth is particularly strong. So when we strip out the exit of distribution and the impact of that single client exit, very strong underlying growth. And you can see the funds under supervision on the right-hand side of the chart and the composition thereof. And a little bit more detail on CTS. In this chart you see along the bottom in the dark blue the PIMCO funds under supervision. In FY17 you can see the business has more than replaced that over the last 12 months with very strong growth and a focus on its core fiduciary services. Now let's move to the balance sheet. Here you can see a summarised balance sheet, which in effect is very strong. Low gearing, substantial headroom and covenants, and surplus borrowing capacity to take advantage of opportunities as they arise. And a simple bridge on the operating cash flow. Again, very strong net cash flow from operations. For the most part, our revenue is direct debited from clients' accounts in some way, shape or form. Very few overdue accounts at all. And on the right-hand side, the two right-hand most bars effectively represents our core liquidity of some $58 million. In summary, the capital position is very strong. We comfortably meet our regulatory capital requirements. The streamlining of structures and entities we've undertaken over the last 6 months is improving our capital efficiency by around 2 to 3 million over the next year or two. It takes some time to flow through to the ineffectiveness as it's averaged over 3 years. And there's also the potential to consolidate licences further and improve capital by a further 5 million in the longer term, and that might take a year or two as there are a number of operational matters that need to be dealt with to affect that. You'll see also here a 10% sustained increase in revenue for CTS requires an additional circa 3 million in longer term reg cap, which for the most part paying out dividends of 70 to 90%, as you can see in the next bullet point, can be met from retained earnings. We've also put in place new and increased debt funding arrangements to provide additional flexibility for regulatory capital needs or selective investment and acquisition. And so in summary, a strong improvement in financial performance. The key initiatives have all been completed on time and on budget. The group operating model review is delivering the 2.7 million of annualised cost savings in FY18, good organic growth momentum, fully funded capital position and capacity to support our growth plans, and an encouraging outlook for FY18 and beyond. So let me pass back to Mick to take you through the strategy.
Thank you, Philip, and I hope people can see that that's a really strong set of results for FY18. Let me talk to you about our strategy and our plans and how we see the outlook for the business. Firstly, I just really want to make this point that Equity Trustees aims to be Australia's leading specialist trustee company. So the key point there is that we are a specialist in trustee services. So we put all of our capital into this, we put all of our efforts into it and all of our intellect into being a specialist trustee company. You can see also we've got a global picture there, and that's because we do have aspirations to move some parts of this business, extend them offshore, and I'll talk more about that as we go through. So we do have a growth agenda. We feel that our specialist approach, where we operate in one part of the value chain, gives us a real competitive advantage. We are playing to our strengths and we can leverage that unique position and particularly leverage it to be the preferred partner of other financial services firms and legal firms who don't seek to participate in this part of the value chain. Certainly we've got very attractive market fundamentals for both our private client business and for our corporate lines of business. And I'll come back to these 3 points, but we do see growth in all the lines of business through organic initiatives, partnerships that we can enter into, and acquisitions as well. We are playing to our strengths, and what are they? Effectively, we provide services in wealth protection and wealth transition. So you've seen this before, but I think it's worth just touching on. We are put into a position of trust in the centre of many of these arrangements, and we govern from that position of trust in the centre. And we are balancing the competing interests and making judgments about different groups of beneficiaries and clients and the like. It's a high-touch position that we're in, dealing generally with high-value clients, both in the private side as well as in the corporate side. It's not a transactional-based type of business, so it's something very difficult to replicate. We do look to leverage our unique position, and what does that mean? Well, it's an independent business that has an unconflicted model. It's not a broad-based financial services conglomerate. We're not competing and focusing on being a large-scale funds manager or advice or platform business. And what that does is it strongly positions us as a preferred partner of many other financial services groups. So, our partnerships go to the very top private banks, financial planning firms, the legal fraternity, various broking businesses, funds managers and other broad-based financial services businesses. And it really is a unique position that we can provide services from. I've thrown this slide up before, and it just talks about the attractive industry fundamentals, and I'm not going to go through all of the detail of it, but if you look on the left-hand side for TWS private clients, the growth there is really underpinned by the demographic changes that are anticipated in Australia. And the older age groups in Australia are the fastest growing age cohorts in the population. In fact, the number of lives over age 85 is expected to double in the next 20 years. So that is real growth over and above the growth of the economy. And there's going to be massive wealth transition with that ageing of the population, and we feel very well positioned to be participating in that. Our two corporate lines of business, the superannuation side and corporate trustee services, really are underpinned by the growth in the mandated superannuation system, which again is real growth over and above the growth in the general economy. There's one new thing on this slide, and that's on the bottom right-hand corner, where we're looking at opportunities for offshore expansion in fiduciary services in our corporate trust business. Now, everyone knows that the Australian funds management and superannuation market is a large market of the order of about $3 trillion, but the global funds management market is $70 trillion. So there are enormous opportunities for players offshore. And I'll talk to you specifically about how we are looking to extend our business in that area. So we are pursuing a clear growth strategy, and it really fits into three categories: organic growth, partnerships and acquisitions. If I just touch on organic to start with, perhaps this hasn't been the focus so much in the last couple of years due to the acquisitions that we've made, but we do see enormous opportunity to organically grow our business, particularly in trustee wealth services, in the private client services that we're offering. We see that we can target new markets where we can have real position of strength, such as the compensatory trust market. We are looking to improve our service and our cross-sell opportunities across the large client base that we have. And we're, as I mentioned before, aligning our approach to meet increasing market globalisation in some lines of our business. And we are also continuing to modernise the business. We're a company that is 129 years old, and what comes with that is a lot of tradition and a lot of trust, and a lot of certainty. But we also need to contemporise the business. And I welcome anyone to come to our offices in Melbourne and Sydney and see what's been happening there. I also encourage you to have a look at our shareholder review, where you'll see really a refreshed branding and approach to the way we're presenting the company. Partnerships, I mentioned that before. We have a real position of strength in partnerships, in that we're not competing with most of our partners, and it does give us an ability to grow our business in each of the lines of business. And acquisitions, we'll be looking for bolt-on acquisitions, importantly of similar businesses to what we're doing now. So these are in our core areas of specialty, and looking to expand our corporate trustee services business offshore. Our focus in trustee wealth services is firstly on estate planning and management, where we are a real leader in terms of our expertise in estate planning and management. We have 50,000 lives in our will bank. We are going to be digitalising that will bank for the first time, and that will give us an ability to do much better data analytics and much better servicing of that client base and understanding its value much more clearly. In trustee management, again, a core specialty in managing trusts. We're targeting particular areas where we have expertise that's leading the market. We are also going to change our business development, so we have dedicated business development employed for each market segment. So instead of generalists, we'll be having specialists looking at different market segments. I want to call out the last section, our philanthropic services. We have $1.7 billion of funds under management in this area, and we're granting almost $70 million a year. We have a fantastic team of professionals who are networked into the not-for-profit and charitable sector, and have a real focus on delivering results for beneficiaries and results for our living donors who are looking to make an impact on the community. We believe we can be a thought leader in this area and are a thought leader in this area and looking to capitalise on this and our brand as well that is linked to our philanthropic activities. To talk about superannuation, well, there's two areas here. The first is our trustee for partner service that we offer. So we feel we can strongly leverage our specialist approach to being an independent trustee for superannuation providers. We can partner with those providers who trusteeship is not core, so promoters, administrators, employers, insurers and the like, who want to participate in a part of the value chain but don't want to provide trustee services. We also will selectively partner with new superannuation providers. So there's been a raft of news in the media in recent months about new superannuation startups. We won't participate in a lot of those startups. We'll only participate in those ones where we believe there's really a sustainable business model to grow those superannuation funds in the future. And finally, fund mergers. We've got capability in merging funds. We've done 2 successor fund transfers through the course of this year. 3 MySuper licences we've been successful in applying for through the course of the year. 14 retirements and appointments of trustees to different funds through the course of the year. So it really is a core expertise that we can provide to other providers and partners in building this superannuation business. Our focus in corporate trustee services, well, firstly is in growing the existing business. You saw that really strong growth that you're seeing from the existing business. We do expect that to continue when we have this leading position in the market. I'm particularly pleased in the trend for some of the highest quality Australian equity managers to enter the retail market, generally on the back of some of the activity that's going on in the institutional market driven by the very large superannuation funds. We are ideally positioned to help those managers as they enter the retail market. We're also seeing increasing demand for our solutions from superannuation fund providers who want to have, I guess, increasingly sophisticated product, and sometimes product that is better delivered through fund structures rather than through investment mandates, and that's been a growth area for our business. We are also at the leading edge of product design, so we have converted many of our trusts to attribution managed investment trusts through the course of the year, giving those clients greater flexibility to expand their distribution with different unit classes, and also ultimately to open them up to expansion into Asia. And the Minister for Financial Services, Kelly O'Dwyer, put out a statement on Friday regarding the government's plans to promote the Asian Fund Passport and to develop a corporate collective investment vehicle regime which will make the Australian vehicles competitive into Asian markets. And as I said, we're at the leading edge of that development and very much looking forward to it. And finally, we'll be looking to extend our services into new markets in Australia. So we've only had a small footprint in providing trustee services to securitisations and debt offers and real estate trusts, but we'll be looking to do that more in the future. We've recruited into that space through the course of the year, and we do believe it aligns very neatly with our core skills. Now, I've talked about the offshore expansion of our corporate trustee services business. I just want to spend a minute on this so people understand what we're doing. So the global funds management market around the world is worth $70 trillion. Now, a very high proportion of those funds are invested via collective investment vehicles. Now, many countries have their own legislation around the establishment of collective investment vehicles, as does Australia, as I just touched on before. But there are a number of offshore locations that are established centres of CIVs. and where funds managers go to those centres to establish product that then they can distribute through multiple markets throughout the world. So we'll be looking to get a presence in one or more of these centres, and they are clearly Luxembourg as the number one in Europe, Dublin number two, London and the Cayman Islands are the most obvious choices. This strategy also will help us to expand into Asia because many of the funds managers use those CIVs from those centres in their Asian markets, as well as potentially having locally domiciled funds in those markets. And as I said before, we'll be at the leading edge of helping Australian fund managers who want to use the new Australian CIVs and the Asian Fund Passport capability to build in the Asian markets. Now, our approach here is we're not going to bet the bank on this strategy. What we need is licences and people and capability, and we want to leverage off our existing offshore client base of funds managers. And that really is the value adding that we believe we can do by bringing those two together, the capability with our first-class global funds management client base. So in summary, I believe we're very well positioned following the restructure and the investments we've made in the business in the last 18 months. No question we are in a very attractive industry for both our private client side and our corporate lines of business. We've got leading market positions in quite a number of the areas in which we're competing, in the RE space, in superannuation trusteeship, estate planning, compensatory trusts and philanthropy, to name a few. We believe our unique proposition and our specialist approach allows us to be the partner of choice for many financial services and legal firms. We're seeing very good underlying organic growth. We've got further opportunities here in Australia and offshore, and we do believe it's an encouraging outlook for FY18 and beyond. So on that note, I'm happy to take any questions that anyone has. So we'll watch on screen as they come through. Thank you. Well, I've got one question here. There's a question that we've achieved very strong growth in corporate trustee services, out of the Australian market. Is it possible that that growth can actually continue, and what's it looking like for FY18? Well, look, there has been very strong growth in corporate trustee services, and some people might think, well, all of the global managers that were coming to Australia are already here, but we've done an analysis of the top 400 funds managers in the world, and only 170 of them are actually represented in Australia. So we do see more growth coming from offshore managers entering this very attractive market. We also continue to see new startup domestic managers, and also, of course, we're seeing new fund designs always coming through that our existing managers are looking to establish. And I touched before on some of the institutional managers in Australia wanting to come enter into the retail market. So there's really three very significant lines of growth that we expect to continue. And there's a lot of activity in the corporate trustee services business right now as we start off the FY18 year. Got another question that's come through here, and that relates to how do we feel about the repositioning of the board and the changes that have occurred through the course of the year. Well, look, quite simply, very positively. We, I believe, have strengthened the board with the appointments of Glenn Sedgwick and Jim Minto over the course of the year. Glenn gives us great expertise in strategy, certainly great expertise given his 30 years in Accenture in organisational development, in technology and operations, and particularly as we embark on globalising the corporate trustee services business, his experience will be very helpful there. And of course, Jim Minto, I know, is well known to a lot of the financial services market. Maybe what is not so well known, he has great expertise in managing trustee businesses, which he brings to bear, which is fantastic, and also great ideas and thoughts for us in terms of funds management and superannuation, where he has brought enormous expertise and experience. And look, I just will touch again on Geoffrey Kennett's soon-to-be appointment as the chairman of the company, and I should recognise Tony Killen's enormous contribution to the organisation. We'll do that more formally at the annual general meeting, but Tony has been on the board for 15 years and been the chairman for 10 years of that time, and has made an enormous contribution and steered the company through a lot of change and incredible innovation over that time. So I want to thank Tony for that. But Jeff comes on as chairman, having been on the board for 9 years. As I said before, he's incredibly passionate about us looking after clients and what we can do with the philanthropic part of the business in servicing beneficiaries and making an impact on the community. And of course, he's incredibly focused on the shareholder and shareholder returns. And so we'll be looking for Jeff to help in building the brand of the business, ensuring that we are commentating and leading industry debate. Perhaps we've hidden our light under a bushel a little bit in the past, but that won't be the case in the future. So I'm very excited about that change with Jeff coming on board. I'll wait to see if there's any other questions. I don't think we've got any other questions coming through, so Philip and I will be out talking to shareholders through the course of this week, all of this week, and leading on to the latter weeks as well, and looking forward to doing that. But just in closing, want to say that we're delighted that we've been able to deliver a very good result for the FY17 financial year. We feel the business is really well positioned leading into FY18, and I hope it's very clear the strategy that we're pursuing, and excited for the prospects ahead. Thank you very much for listening in this morning.